You've got $100,000, and instead of letting it rest in a bank earning trivial returns, you wonder what's the smartest way to invest it without spending hours staring at stock charts. You want to put it to work, but not just anywhere. You're eyeing 5 powerhouse Fidelity Index Funds. Now, what if I told you that this decision could take that $100,000 and turn it into something truly remarkable? I'm not talking about small gains. I'm talking millions. In this video, I'll show you and the money explorers the 5 best Fidelity Index Funds to invest $100,000. I'll also show you how much it can generate over 10 years and 20 years. I'll show you funds that pay over $225,000 in monthly dividends. And in the end, I'll show you a Fidelity fund that has the potential to turn a $100,000 investment into a portfolio valued at over $20 million. When it comes to selecting the right index funds, it's not just about picking the biggest names or the highest returns. There's a method behind it. The 5 Fidelity Index Funds I'm showing you today are carefully chosen based on a few key criteria: growth potential, dividend yield, sector performance, and long-term stability. Coming up are the top 5 Fidelity Index Funds ranked from good to absolute best for their potential to add serious value to your portfolio. Starting at number 5, we have the Fidelity MSCI Consumer Staples Index ETF with the ticker symbol FSTA. This is a fund that lets you invest in the necessities, the backbone of the economy. This index fund is heavily weighted toward consumer defensive stocks, meaning it includes companies that provide goods and services people can't live without no matter the state of the economy. FSTA's top holdings read like a who's who of consumer staples. Procter & Gamble, Costco, Walmart, and Coca-Cola dominate the list, making up over 63% of the fund. These companies have strong brand recognition, solid global operations, and a proven track record of withstanding economic downturns. The fund focuses entirely on consumer defensive stocks with over 98% of its assets in this sector. FSTA is a reliable income generator with a current dividend yield of 2.39%. Its 10-year dividend CAGR of 10.7% is even more impressive, showing that it's been consistently boosting its dividend payouts over the long term. With a record of 10 consecutive years of dividend payments and 7 years of growth, FSTA is a solid choice for balancing income with capital safeguarding. For example, during the 2008 financial crisis, consumer staples fell by only 15% while the S&P 500 dropped by more than 38%. This stability, combined with steady growth, makes FSTA a compelling option for careful investors like the money explorers, who value both safety and long-term results. Let's look at what happens if the money explorers invest $100,000 in FSTA. Historically, FSTA has delivered an average annual return of 6.41%, reflecting its focus on staple goods. After 1 year, the money explorer's investment could grow to approximately $118,800. Fast forward 10 years, and the investment might reach around $243,700. If they hold on for 20 years, the value could rise to about $681,000. And after 30 years, the money explorers could watch their investment balloon to roughly $2,344,387. Not only that, but the annual dividends by year 30 could provide the money explorers with an income of $165,400, or about $3,788 per month. Over these 30 years, the total value added to the portfolio would be about $2,244,387 from capital appreciation and $1,974 from dividend reinvestments. At number 4 is the Fidelity MSCI Consumer Discretionary Index ETF, ticker symbol FDIS. Unlike consumer staples, the consumer discretionary sector includes companies whose products and services are considered non-essential. Think luxury goods, entertainment, and leisure activities. FDIS is all about expansion and ingenuity, capturing the dynamic consumer discretionary arena. This fund invests in companies that thrive when consumers have disposable income to spend on non-essential goods and services, making it the perfect fund for those looking to tap into the spending habits of a booming economy. FDIS is heavily weighted toward industry leaders like Amazon, Tesla, and Home Depot, with these 3 alone comprising almost 39% of the fund. The fund's allocation to consumer cyclical stocks makes up 96% of its holdings, meaning it's highly leveraged to sectors that can experience explosive growth when the economy is strong. Although FDIS isn't primarily an income-focused fund, With a dividend yield of just 0.76%, it compensates with solid advancement. The fund has an impressive 10-year dividend CAGR of 11.22%, showing that it's steadily raising its payouts even if the initial yield is modest. With a history of 10 consecutive years of dividend payments, FDIS still offers a growing income stream for long-term investors. During the 2010 to 2020 period, this sector returned an average of 16% per year compared to the S&P 500's 13.3%. Now let's see what happens if the money explorers place $100,000 into FDIS. After 1 year, their investment could grow to about $112,100. In 10 years, this could swell to approximately $315,900. If the money explorers hold on to this fund for 20 years, their investment might grow to around $995,000, and after 30 years it could surge to roughly $3,133,023. By then, they could be earning nearly $20,000 in annual dividends, about $1,665 per month. Over 30 years, the total value added to the Money Explorers portfolio could be approximately $3,332,003 from capital appreciation and $1,181,182 from dividend reinvestments. The sector's sensitivity to economic growth makes it a powerful engine for long-term wealth accumulation, perfect for an investor like the Money Explorers aiming to capitalize on economic booms. If you think those returns are impressive, just wait. At the end, I'll reveal a Fidelity fund that has the potential to reach that valuation in only 20 years and could surpass $20 million over the long run. Next up at number 3 is the Fidelity MSCI Healthcare Index ETF, ticker symbol FHLC. This fund covers the healthcare sector that always stays in style, with consistent demand regardless of economic cycles. This stability is appealing to investors seeking a mix of security and growth. The sector's performance during downturns, such as the 2008 crisis, when it declined by only 22% compared to the S&P 500's 38% drop, underscores its defensive nature. FHLC is dominated by heavyweights like Eli Lilly, United Health Group, and Johnson & Johnson, with these top 3 holdings making up over 25% of the fund. Almost 100% of FHLC's assets are invested in healthcare stocks, making it a pure play on the sector. This concentration offers valuable stability, especially during uncertain economic times when the demand for medical services remains steady. FHLC provides a modest dividend yield of 1.26%, but what sets it apart is its impressive 10-year CAGR of 16.8%, showing that dividend payouts have been snowballing, a key factor for income-focused investors. With 10 consecutive years of dividend payments, this fund has a strong record of rewarding shareholders. If the Money Explorers invest $100,000 in FHLC, they might expect an average annual return of 9.24%. After 1 year, their investment could be worth about $110,500. In 10 years, it could grow to around $283,300, and over 20 years the investment might reach approximately $931,315. By year 30, the Money Explorers could collect annual dividends of roughly $33,500, or about $2,295 per month. Altogether, the total value added to their portfolio over 3 decades could be about $3,963,315 from capital appreciation and $1,581,199 from dividend reinvestments. Taking the second spot is the Fidelity NASDAQ Composite Index ETF, ticker symbol ONEQ. If you're looking to ride the wave of technological innovation and market disruption, ONEQ is the fund for you. This ETF tracks the NASDAQ Composite Index, which includes some of the world's most innovative and fastest-growing companies. It's essentially a bet on the future, focusing heavily on tech and other growth-oriented stocks. Historically, this index has outperformed many others, especially during major technological advances. For example, from 2010 to 2020, the Nasdaq returned an average of 17.5% per year, well above the S&P 500. If the Money Explorers decide to invest $100,000 in ONEQ, they'll find that while the fund isn't a big dividend payer, with a yield of just 0.64%, it has steadily increased payouts with a 10-year dividend CAGR of 7.35%. Even more impressive, it has delivered an average annual return of 14.44%, powered by its focus on technology and other progressive industries. After 1 year, the Money Explorer's investment could grow to around $105,080. 10 years later, it might be worth about $401,500. Holding for 20 years could raise the value to roughly $1,577,234, and after 30 years the investment might soar to nearly $6,134,377. By then, annual dividends could reach about $4,063. Over 30 years, the total value added to the portfolio might be approximately $6,343,007 from capital appreciation and $56,500 from dividend reinvestments. Technology accounts for more than half of this fund's assets, with other significant allocations to communication services and consumer cyclical sectors, giving investors broad exposure to industries driving the modern economy. Finally, taking the number 1 spot is the Fidelity MSCI Information Technology Index ETF, ticker symbol FTEC. FTEC is the ultimate choice for tech enthusiasts, providing concentrated exposure to the information technology sector and investing in companies that are actively shaping the future. If you believe in the transformative power of technology and its ability to drive market growth, then FTEC is the perfect selection for you. FTEC's top holdings include the tech titans Apple, Microsoft, and Nvidia, which together represent nearly 50% of the fund. With 99.42% of its assets invested in technology stocks, this ETF is all about capturing the explosive growth potential of the tech industry, from software and semiconductors to cloud computing and artificial intelligence. While FTEC's current dividend yield is a modest 0.66%, its 10-year dividend CAGR is an impressive 19.08%. This rapid expansion in dividend payouts shows that the companies within the fund are reinvesting for growth while still returning value to shareholders. For long-term investors, that means a steadily increasing income stream alongside significant capital appreciation. If the Money Explorers invest $100,000 in FTEC, the potential returns are remarkable. With an average annual return of 18.67%, after 1 year their investment could grow to about $119,933. In 10 years, it might climb to around $586,500. Over 20 years, the value could rise to roughly $4,270,246, and by the end of 30 years the investment could approach a breathtaking $12 million. By that time, the Money Explorers could be earning annual dividends of well over $126,000, more than $10,500 each month. The total value added to their portfolio over 3 decades could exceed $12 million when combining capital appreciation and dividend reinvestments. Click the video on the screen to explore REITs that can deliver similar results with just a $10,000 starting investment, and continue your journey with the Money Explorers toward lasting financial growth. Thanks for watching the Money Explorers. Don't forget to like, subscribe, and share for more smart investing tips.